Hi, I'm John Kane with Cook Martin Polson, and today we're going to talk about showing a loss on your tax return. Is that a bad thing? Is it risky? What do I need to be aware of before I take a loss on my tax return? You know, in the direct selling world, the IRS kind of scrutinizes that a little bit because the direct selling world, there's not a whole lot of barriers to entry, and so it's very easy for someone to get into the industry, which is great for people because it's a great opportunity to start a small business, but at the same time it's also an opportunity to show maybe a loss that shouldn't be taken on a tax return. So we're going to talk about some things to be aware of in showing a loss. The IRS does allow you to deduct any expenses that are associated with your trade or business, but you need to make sure that you're passing these tests, or the hobby loss rules is what they're frequently referred to as. Make sure you're aware of the manner in which the activity is being carried out. Are there budgets? Are there books? Is there an accounting record? You know, does it look and smell like a business? Does it pass the smell test? Next would be the expertise that the taxpayer has. How well does the taxpayer know the industry, know what the product that's being sold, how comfortable are they in that arena? The next would be the time and effort that's expended. Not that having a little side business is a bad thing, but if no time is being put into the business, then obviously the IRS isn't going to look at that favorably. The next thing that they're going to look at is your success in other activities. If you did have a business that struggled in the past, then that might work well in your favor that, you know, this one's going to turn a profit, you know, down the road. So they will look at that history. They're going to also look at the history of the business. If it's showing a loss year over year over year, then they're going to look at that and make a determination as to whether or not it is a legitimate business or if it is a hobby. Next, they're going to look at, okay, how is this loss being funded? Who's paying for it? Where's the money coming from to take these deductions? Is there, you know, a large, you know, day job that produces all this income, and this is a way to kind of funnel some loss through so that you're minimizing your tax, or is it a legitimate business? And then they're going to look at elements of personal recreation. And the IRS is aware that, you know, in order to produce income, there are marketing expenses and meals and entertainment, that kind of a thing. But they're going to look at that, you know, and kind of determine, you know, whether you're being maybe a little too aggressive or not in that arena. So these are important factors to consider both before starting a business and as well throughout the duration of your business when you may have the opportunity to report a loss on your tax return. These are just some of the factors to consider, but we want to make sure that you're not opening up yourself to any unnecessary audit risk. So if you do have any additional questions about your specific situation, don't hesitate to reach out to us. We're happy to help and answer any questions that we can. Thanks.